Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for September 19th of 2022. Here's our disclaimer for important information. A quick check-in here on our high-frequency data. Our indicators looking a little bit softer than they have in recent weeks. We see the last two columns there on the right, the month-over-month and the week-over-week change. We see a little bit of erosion, particularly in the weekly data with regard to open table, TSA checkpoint data, global commercial flights pretty much flat, and then supply of motor gasoline. And we know that that number has been going down. Some of this is seasonal as we transition away from the peak travel season. Some of it is a little bit more endemic, maybe emblematic of some of the demand issues that we've seen out there. We also see fairly tepid data for the month on steel production, rail car traffic, and we've been noticing that for a while now. Obviously, the labor market remains extremely tight. We do see consumption continuing. People are using their credit cards and other forms of credit to help substantiate their spending, which is something that we obviously want to watch. But as we look at these data points here, it's clear that this overall trend of slowing is intact, even if we haven't yet seen it embed itself in the inflation data rolling over. One of the big releases over the last week was the PPI, the Purchasing Price Index, or Producer Price Index, rather. You can see in the graphic representation here, looking at both the all-in number as well as the core number. When you look at the all-in number, the actual number was slightly below expectations, although still pretty high at 8.7. And then on the core number, which subtracts out the food and energy related components that are most volatile, it was a little bit hotter than we were looking for, about 7.3% versus the estimate of 7%. So just like CPI, which is what we got a week prior, we see producer prices are definitely coming down in a noticeable fashion, but it's clear it's just going to take a while for it to get there. Speaking of the CPI, here's a kind of a refresher for the data that we got last week. You can see the trend line. You can see in this particular representation from Y charts that, that long-term downtrend in overall inflation that was kind of straddling below the 2% or straddling the 2% line. You can see where that is spiked up, and you see that consumer prices are off their peak. Now, if you look at the more deeply blue line here, that's the core prices. And so when we looked at the data when it was released, obviously the headline number has come down. You can see that here in that light blue, but that dark blue actually had a slight uptick back up to 6.32. And so that's what really unnerved the market. Both of those were really kind of exceeding or in excess of the market estimates, and just more, food for fodder here that that inflation is going to take a longer period of time to come down, even though we are seeing some of the demand destruction elements that is a key focal point of some of what the Fed is trying to accomplish. Here's a look at the year-over-year change numbers for the July CPI as well as the August CPI. So you want to, spend some time thinking about, rates of change and where is the inflation coming from, where is it abating, so on and so forth. I mean, really, you can see here gasoline is off, fuel oil is off, but you see other areas that are rather sticky still. Transportation costs actually went up, and most notably, we saw food at home go up as well. But you see these other components, food away from home, slightly higher, used cars slightly higher. Shelter continues to remain a little bit sticky. Overall, it's up slightly over the year-over-year pace that was established in July. And so you can see here it's fairly broad-based. It wasn't really one area in particular that kind of drove this per se. Here's a look at the CPI and the core year over year. You see the bars and the month over month. Those are that's, as I said, is a monthly data. And then you've got the year over year data in the blue and then the green lines there. And, what's notable in this here is not necessarily where we've come from, because I mean, that's pretty well understood, and we just showed you those charts on CPI, but it's where we're going and how quickly is that going to happen. And I think, when you look at on the right-hand scale are those percentage numbers for core and all-in headline year over year. You can still see that, looking out into 2023, that we're still kind of staring at least the consensus estimate here of somewhere between 3 and 4%. Still digging a little bit into the components of inflation. This chart I thought was really interesting from BLS, Bureau of Labor Statistics. On the left-hand side, you've got the components and the weights within the CPI, the Consumer Price Index. And as we know that really the three biggest ones are housing, food and beverages, and transportation. And those are the ones that have exhibited perhaps the highest amount of inflation. Now, as we saw a couple of slides ago, this year over year number is being driven by a lot of places, but primarily in housing, which is catching up to some degree. We see that its weighting is well over 40%. Food and beverage is about 15 to 20%, and transportation is about closer to 20%. So those are the big drivers, and we've got inflation in all those areas, running pretty hot. 8% for housing, then we've got almost 11 to 12% for food and beverage, and even more for transportation. Other areas are contributing, although not nearly as much. And then on the right-hand side, you can see where the weight of components, the kind of the percent of the components that have experienced this year at various points 6% or more inflation has gone up to about 70%. So that means that 70% of the index components at one point have experienced greater than 6% annualized inflation. And as I was just talking, here's food CPI, the food component of inflation. And you can see that that's about 11%, almost 11.5% year over year for the month of August. Now we'll switch gears here and talk about manufacturing and some of these other economic indicators, and then we'll get into interest rates, and then maybe a little bit of discussion about the market here. But manufacturing production kind of really continues to surprise a little bit on the upside. We did see it flagging a little bit, but it's recently taken another uptick in August. So, we do see production trying to generate more inventory for a demand environment that seems to be weakening, but we have not seen that dislocation in like inventory to sales ratio like we would expect. Inventory to sales actually holding up reasonably well, and then obviously we can see here that manufacturing production is still going pretty strong. Here's a slide on real average hourly earnings on a year-over-year basis. So when I say real, that means that it's nominal earnings minus inflation. And so we do know that wages have been going higher. We know that labor is tight, particularly in some industries, particularly in service industries, and particularly in lower income levels. But in this chart, what it's telling us is that we've had almost a year and a half of consecutive negative real wage growth. And so what that tells me as we kind of look at the landscape over the next 6 months is that I think consumption just by its nature has to slow because purchasing power is eroding in this environment of high inflation. Now, I do think that, obviously the Fed is trying to control demand, and I think if you control demand, that brings inflation down. It all takes time. Some of these interest rate increases that are happening like in real time right now, and what will likely happen at this next Fed meeting is it will take about 9 to 12 months to kind of filter itself out into the economy. And so I think this is telling us right here in this chart that we're going to have some consumption slowing at some point, which honestly is very good. It helps us, again, get to that next upcycle a lot sooner than we would. And I know the Fed is looking at this data and will continue to monitor it as we will as well. This is a credit conditions index for the National Federation of Independent Business. NFIB is kind of a proxy for small business. We see here in this chart that we've got credit conditions seemingly beginning to erode for the average small business. Here's something that should be a benefit to savers. We haven't seen a real benefit in terms of money market rates in quite a while. But on the upper hand side, we've got research from B of A. We've got the 4% money market yields that are really within sight right now. After we get this next interest rate increase, I think it's a real possibility, and that gives you more options in terms of diversifying a portfolio where cash is a real, has real return to it. It's not just a store of value and a stable store of value, which obviously some people like, but if you can get a yield on your cash and not have to take really any risk to get it, then it becomes a much more viable alternative to other asset classes. And I think we're on the cusp of seeing that right here. Now you see on a long-term rolling 10-year annualized basis, you can see that begin to turn. And of course, you look at that upper chart and you see basically from the end of the global financial crisis through roughly about 2015, we essentially had zero rates. And so that inflection point has happened. We've begun to see that. And obviously that's very good for savers. Here's a quick look in at the 1-year Treasury yield. Again, more of what I was just talking about. You see the highest rate on that T-bill that we've seen since 2007 here. And like I said, we're approaching 4%. So just as I said, the short-term rates are moving higher. Of course, the yield curve is inverted, and we've got a slide that kind of highlights that transition. But right now, if you're looking at it from the saver's perspective, this is really not a bad circumstance. And just as I'm talking about increased yields at the short end of the yield curve, we have to go back and talk about basically bank savings accounts here and what's being paid. Now these deposits are coming fairly cheaply. But I do think that's going to change. So you've got here a lot of the major banks and what they're currently paying on FDIC insured accounts, which is basically nothing. So even as we've seen interest rates move higher at the short end, it hasn't manifested itself in the banking sector. And the banking sector is actually going to be putting itself at a major disadvantage if they don't increase that. And I can say that, from at least from the standpoint of our investor monies, we're clearly looking for better yields on that cash and trying to solve the riddle for short-term cash equivalent, investments that can provide a higher yield for our clients. This is one of the most interesting charts that I've seen in a while, and it plots at various maturities the change in the Treasury yield curve from really just the end of last year. And so much has happened this year. Obviously we came into the year with this threat of inflation. We knew interest rates were eventually going to go up, but they certainly did. And you can see that here as we transition from the block of red columns into basically the blocks of the blue. And so the blue represents 2022, where we are as of the 13th of this month, and then the red represents where we were at the end of last year. And you can see that end of last year we had an upward sloping yield curve, meaning that we had very, very low short-term rates. You can see that 0.06 in the 1 month, basically all but equaling zero in that case. And then the 30-year bond was yielding about 1.9. Well, now that's 3.5%. So a tremendous increase there. And given the abundance of short-term rate increases that we've seen here in 2022, you can see where the front end of that curve, where the 1 month, 3 month, 6, and 1 year, all of those are much higher. In fact, the 1 year now at 3.92 that we just saw in that other slide is actually about 0.5% higher than the 10-year yield. So, again, we have this inverted yield curve. You see that little hump there at the 1 year, and then it kind of slides back down. The 10-year yield now is about 3.42. So, again, that shows us how far we've come in a relatively relatively short period of time, but it also gives us a window into the potential for slowing, given the fact that short-term yields are higher than long-term yields, which notates an inverted yield curve, as they say. This is a slide on real disposable personal income year over year. And we can see in this transition that while incomes have gone up, that the real disposable incomes have actually not. And that's just a function of the inflationary environment that we're seeing right now. We know that inflation's been high. And so when you subtract that from personal income growth, that it turns out to be negative. And this is, it's just odd because we haven't seen this before, that incomes are actually not moving up too slowly. It's just that we have a lot of inflation right now. And you see this going back to 1948, that we're just in a very odd place for that. One of the more interesting things that we've seen here over the last several months is the gradual decrease in gasoline prices. Certainly, for lower income workers that have to go to work, that can't telecommute or work from home or whatever, it's been a clear kind of kick in the pants, if you will, for those folks. I mean, and they tend to feel that price inflation a lot more. You can see in that red line here, we're about $3.71 a gallon on a national average, and that is considerably below the peak that we saw back in June. You can see how this compares with other years. That were kind of in rarefied air, at least over the last 3 to 5 years. In fact, that June peak was an all-time high. So you can see that consistent decline. That's obviously been a help for consumers and helps them with their overall spending capability. This is industrial production on a month-over-month basis. Now we do know that the year-over-year data still looks reasonably okay, but then if you look at it on a month-over-month basis, we're beginning to kind of stall out here a little bit. Even though the numbers are still actually positive, that rate of gain is slowing here. In fact, turned slightly negative for the industrial production survey, which was expected to be flat, but it turned out to be slightly negative. And then if you look at our manufacturing production within total U.S. industrial production, that was pretty much flat to slightly up for the month. Here's a refresher on our housing industry. You've got monthly rent, which continues to move higher. Actually, I showed this a few weeks ago. It came back up in the reading. I thought I'd show it again. That rents are moving higher, but the rate of gain is slowing. It is up 10% year over year, but the rate of change is slowing, and I think that's important. Don't think it's necessarily going to re-accelerate, especially if we head into an economic downturn. Then would expect that to kind of stall out a little bit. But on the right-hand side, we've got the Case-Shiller National Home Price Index numbers, and you can see the aggregate rate of change year over year is still relatively high, but it's coming off its peaks, and we're seeing a noticeable change in market conditions in some areas of the country. Here's our earnings model. We've got Bank of America global EPS. So again, not just the U.S., but global EPS. We have these numbers that are looking to roll over. And we've seen consistent downgrades of earnings estimates for domestic companies, but we've also seen it globally. And so I think this is a synchronized, decline and is putting more pressure on international markets. And in response, we've really taken off most of that international exposure and really focusing on the companies that can deliver that have strong balance sheets, that can deliver dividends and dividend income, and that can return capital to shareholders. And what this tells you is that the companies that are not doing a very good job of generating cash flow, of generating profits, even in a tight margin environment, are really going to likely underperform in the coming months and quarters. Here's a look at median PE ratio, and then on the right-hand side, we've got a proportion of U.S. stocks with a PE ratio of less than 10. And so in this case, I'll focus on that one first. In that red there, you see that we're about 30% of the S&P 500 here actually has a PE ratio of less than 10. So there are pockets of cheapness. Again, you've got some of these technology stocks that still trade at the stratospherically high multiples, but you have a lot of other companies, and particularly value companies, which could outperform in the coming quarters. Overgrowth, that you do have an abundance of these that are actually trading at very cheap multiples. And again, in defense, that probably typically trade at relatively cheap multiples, but just looking at it on its face, the S&P itself may be certainly, perhaps more expensive than what some people would like, but there are pockets in their investments within that index that are actually quite attractive. On the left-hand side, rather, you've got the median PE ratio, and so we're a little bit under 15 right now, so that just means that half the stocks have a PE ratio above that, and half have a PE ratio below that. And you can see, the line of best fit, the long-term median there is a little bit north of 17 and a half. And this shows you that we're, actually not expensive relative to history. And I thought I'd end on this slide. This one was pretty interesting. It's a cross-section of profit and loss statements for S&P 500 members, as we kind of get our arms around inflation and inflationary components and which parts of inflation are rather sticky. Obviously, one thing comes to mind is labor. Now, material costs have been high, and we've had supply chain shortages, and we've had industrial commodities that have been very expensive at various times over the last, call it 12 to 18 months. But what is the relative hit to companies, to these various things? And when you look at a cross section, a breakdown of costs, if you will, which is what Bank of America does for us right here, a breakdown of costs for companies in the S&P 500, what you get is kind of an interesting analysis. You get labor, and direct labor is 40%, and indirect labor costs are another 34%, and then material costs are 26%. So labor is really influential here in terms of the costs and profitability for the S&P 500. We know that wages have been relatively sticky. Now we do see hiring intentions begin to roll over, and in some cases, while labor is still pretty tight, it's not necessarily tight in a lot of different areas. And so, there is an interestingly competitive marketplace, but I do think wages and labor costs are going to remain relatively high. And honestly, if you're going to get a margin pinch for the S&P 500, meaning that you're going to see margins be adversely impacted relative to expectations, it's likely going to come from the labor component just being more expensive than what anyone thought. Material costs, again, at 26% are important, but they're not everything. So while we had a lot of concern and anxiety over commodity costs over the last year or so, it's clear that just from a cost concentration standpoint, that labor is much more important. Well, that's all we have for the chart back this week. Hope you have a wonderful week, safe week, and look forward to talking to you again soon. Take care. Bye.